Welcome to the deep dive. We're here to take that just overwhelming fire hose of tech and market data, really boil it down to the essentials for you.
Yeah, the actionable insights you actually need.
Exactly. And today, we are tackling a big one, a critical deep dive into Apple Inc., ticker AAPL. This is the company that, for better or worse, really defines so much of the global tech landscape.
It really does. Hard to escape it.
Right. So our mission today is very focused. We want to cut through all the noise, all the complexity, and really pull out the most important insights for you. We're looking at Apple's strategy right now, its financial health, and crucially, this incredibly complicated web of risks, regulatory, geopolitical that are really shaping its future. We're doing this so you, the learner, can get a clear but also, a really thorough understanding of where this giant actually stands today, and maybe figure out if that current valuation even makes sense.
And that valuation point, that's really the perfect place to start, isn't it? Because the core investment thesis for Apple right now, it's all about this pivotal structural transition they're undergoing.
Transition. Okay. How so?
Well, for years and years, everyone judged Apple based on the iPhone cycle, right?
Yeah.
It was all about hardware sales, these big product hits, very cyclical.
Yeah, totally. Will the new iPhone sell well? That was the question.
Exactly. But now, strategically, they are shifting, migrating towards becoming a much more resilient company, one driven by high-margin services. It's moving from hardware cycles to a services platform.
Okay, and that structural shift, that's what's supposed to justify this, pretty hefty premium valuation analysts are talking about. Around, 33, 34 times earnings?
Precisely. That's a huge multiple, especially for a company whose main product, the smartphone, well, that market's pretty mature now.
It is. So how does the math work? How do they justify that premium?
Well, you see it immediately when you break down the economics of their two main businesses. It's the success of the services division that's completely reshaping Apple's profit picture.
Okay.
So when you dig into the segments, services gross margins, they're consistently over 75%.
75%.
Yeah, it's dramatic. Now, compare that to the hardware side, iPhones, Macs, iPads, where the gross margins are more like, around 35%.
Big difference. Huge.
It's massive. And that difference, that margin gap, that's the engine pulling the whole Apple business model towards this high margin platform structure. That's the story the market is buying into with that high multiple.
That's fascinating. So the perception might still be hardware, but the profits, they're increasingly coming from services. Quite a conflict there. Okay, right, let's unpack this a bit more then. Before we dive deeper into the financials and all those risks, we really need to understand what protects Apple, what keeps competitors at bay. It's not just one product, is it? It's the whole ecosystem, that walled garden everyone talks about. What actually makes it so strong?
Yeah, that term walled garden, people sometimes use it negatively, but honestly, as a defensive strategy, it's incredibly effective.
How so?
It's defined by the seamless integration, and this is key, the intentionally seamless way everything works together. iPhone, Mac, iPad, Apple Watch, they're designed from the ground up to interoperate perfectly.
So it's not just separate devices, it's like one continuous experience.
Exactly. It's less a collection of products and more like an integrated digital lifestyle they're selling you.
And the result of that integration is, it makes it really hard to leave, right? Those switching costs we hear about.
Precisely. Apple has been meticulous, absolutely deliberate in engineering these incredibly high customer switching costs.
High costs, meaning?
And they're not just financial costs, like, selling your old iPhone and buying an Android. It goes much deeper. They're functional, procedural, even psychological costs.
Psychological, interesting.
Well, think about the little features that you kind of take for granted if you're inside the Apple bubble. Things like handoff, you start an email on your Mac, finish it on your iPhone seamlessly.
Yeah, I use that all the time.
Or universal clipboard, copying something on your iPad and pasting it instantly on your Mac. And then there's the big one. The deep, almost cultural integration of iMessage and FaceTime across all the devices.
Yes, the green bubble effect. Nobody wants to be the green bubble in the group chat.
Exactly. You switch platforms, you lose those productivity integrations immediately, sure, but you also, maybe more painfully, become that person who kind of downgrades the messaging experience for all your friends still on iPhones. That's a really powerful social reason not to switch.
It really is. And you see this in the numbers, right? The customer loyalty.
Oh, absolutely. This lock-in translates directly into customer retention rates that, frankly, their rivals just can't seem to match. Study after study puts iPhone retention somewhere between 89 and 92%.
That's incredibly high for electronics.
It's almost unheard of for a mass market product. Now look at their biggest rival, Samsung. Their retention rate is, significantly lower, usually around 77%.
So like a 12 to 15 percentage point gap.
Exactly. That huge gap. That's the pure economic power of the ecosystem moat in action. Once they get you in, it's very, very hard to leave.
Okay, so high retention is key,
Yeah.
but the ecosystem also creates these network effects,
Right.
especially with the App Store. That seems like the engine room.
The App Store is, it's a textbook example of a powerful, self-reinforcing, two-sided network effect.
Okay, break that down. Two-sided.
Right. So on one side, Apple has cultivated this absolutely massive installed base of iOS users. It's over 2.3 billion active devices now globally. And critically, these users tend to be affluent. They spend money.
Okay, lots of valuable customers.
Exactly. So that large, valuable user base naturally attracts the best third-party developers. They build their newest, coolest, most polished apps for iOS first because that's where the money is.
Right, makes sense.
Then, on the other side, the availability of this huge library of high-quality apps, over 1.5 million, now makes the iOS platform itself even more attractive to new users, which, in turn, attracts even more developers.
It's a virtuous cycle, a flywheel, basically.
It's a flywheel that just gets stronger and spins faster the bigger it gets. And that scale creates enormous barriers to entry.
Barriers for who? Other phone makers.
Primarily for anyone thinking of launching a new mobile operating system to challenge the iOS-Android duopoly. It's almost impossible now. But the barriers aren't just software.
Oh.
Think about Apple's operational scale. Their sheer size gives them massive advantages in buying components. They negotiate deals for hundreds of millions of screens, chips, sensors every year.
Yeah, a startup couldn't possibly get those prices.
Not even close. They'd be at an immediate, significant cost disadvantage. And then there's the sheer capital intensity required to even play in this game.
You mean the R&D spending?
Exactly. You have to invest constantly and massively just to keep up. Apple's R&D budget, it topped $31 billion in fiscal 2024.
31 billion.
Wow, that number alone is a prohibitive barrier for almost any potential new competitor. And increasingly, that R&D isn't just about incremental improvements. It's focused on developing proprietary technologies, like their own chips, specifically designed to make that moat even deeper and wider.
So they're investing to create things others literally cannot buy.
Precisely. They're building walls within the walled garden.
So if we tie this all together, the phone market, especially in developed countries, it's saturated, right? Over 90% penetration.
Very mature market.
So in that kind of environment, being able to hold on to your existing customers through these high switching costs, that's actually more valuable, more defensive than trying to win over a few new users here and there.
Absolutely. Retention is the name of the game in a mature market. It protects your margins. Winning new users is expensive and difficult. Apple's entire strategy seems geared towards protecting its highly profitable installed base.
And the data, like those retention numbers, suggest it's working incredibly well. Okay, this is where, for me, it gets really interesting. Because the financial data, it basically shows Apple as two different companies almost, operating under one banner.
That's a great way to put it, a two-speed company.
Right. You've got the hardware business, the iPhones, Macs, which is kind of in the slow lane now, facing maturity, cyclical ups and downs.
The traditional Apple.
And then you have the services business, the App Store, subscriptions, which is like the fast lane, high growth, super high margins, the accelerator.
And understanding that financial split, that two-speed reality, is absolutely crucial to understanding the stock today and why it holds that premium valuation.
So let's look at the slow lane first, the hardware dynamics. What's the picture there?
Well, it's a picture of overall stagnation, but with some important nuances within it. Take smartphones, which is still, the biggest chunk of their revenue.
Right, still the iPhone company in many ways.
Exactly, but that global market is mature. Forecasts show really modest unit growth, maybe just 1% globally in 2025. And the core issue is these lengthening replacement cycles.
Meaning we're holding onto our phones for longer before upgrading.
Precisely. If the new features each year aren't compelling enough and the phones themselves are more durable, people just wait longer. In the US and Europe, the average is now over 3 years between upgrades.
And since growth there comes from upgrades, not new buyers mostly.
That directly pressures the core revenue stream. It slows down the upgrade velocity. So Apple, and the whole industry really, responds by focusing on premiumization.
getting us to spend more when we do finally upgrade.
Exactly. Pushing higher-end models with better cameras, more AI features on board, fancier materials. They're fighting for a bigger share of your wallet, even if they can't increase the volume of wallets much.
Okay, so that's the iPhone story. What about the other hardware? Mac, wearables.
Well, the Mac PC market is famously cyclical, always has been, but it actually looks poised for a bit of an upswing in the near term.
Oh, really? Why's that?
There's a forecast for global PC volume to grow about 3.7% in 2025. And a big catalyst for that is Microsoft ending support for Windows 10 in October 2025.
The forced upgrade cycle for businesses.
Exactly. A lot of companies are going to need new hardware to run Windows 11 smoothly. And Apple, with their really impressive custom Silicon Macs now, they're well positioned to grab a bigger slice of that premium corporate refresh market.
Interesting. So a temporary boost for Mac, maybe?
Yeah.
And wearables. Apple Watch, AirPods.
That's actually the brightest spot in hardware for long-term growth. That segment, Watch, AirPods, HomePod, is projected for really robust double-digit compound annual growth. Think somewhere between, say, 12% and maybe even close to 19% per year.
Wow, that's strong. What's driving that?
It's fueled by the continued boom in health and fitness tracking, plus the broader integration of Internet of Things or IoT capabilities into everyday devices. The watch is becoming a serious health tool.
Okay, so to recap the hardware slow lane, iPhone is mature and reliant on premiumization. Mac has a cyclical boost coming, and wearables are the real structural growth engine there.
That's a good summary.
Now let's shift gears to the fast lane. The services growth engine. Just how fast is this thing moving?
It's moving very fast, and it's really the engine driving the whole investment narrative right now. Services revenue grew almost 13%, 12.9% year over year between fiscal 23 and 24.
And the total number.
It hit a massive $96.2 billion. And crucially, look at its share of the total pie. Services now make up nearly 25%, 24.6% of Apple's total revenue.
Now, up from under 20% just a couple of years ago.
Exactly. It was 19.8% in fiscal 2022. So the trend line is crystal clear. Services are taking a bigger and bigger bite out of the top line.
Yeah.
And that's exactly what the market wants to see given those high margins.
Almost a quarter of all sales now coming from that stable, high-margin recurring revenue model. How are they actually maximizing that? What's the strategy?
The core strategy is all about increasing the average revenue per user ARPU across that gigantic installed base.
That 2.3 billion active devices number you mentioned.
Yeah, right. And they also just crossed 1 billion paid subscriptions globally. 1 billion. So the focus is on getting each of those users to subscribe to more things, cross-selling and bundling services.
So converting someone who bought an iPhone into someone who also pays for iCloud storage, Apple Music, maybe Apple TV plus Veil.
Exactly. Fitness plus L, Apple Arcade for games, Apple Care for warranties, and of course the commissions they take from every sale in the App Store. It's about building that stack of recurring revenue from each hardware customer.
And that provides much more financial stability and predictability than the sort of quarterly ups and downs of hardware sales, right?
Absolutely. It smooths out the earnings, reduces the cyclicality, and boosts the overall profit margin.
And we can actually see this structural shift impacting the company's overall financials, can't we? Even if the total revenue number looks kind of flat, which seems counterintuitive.
It's the clearest proof that management is executing on this strategy. If you look at Apple's total net sales over the last 3 fiscal years, they've been remarkably flat, around $394 billion in FY22, down slightly to $391 billion in FY24, basically stagnant top line.
Right, not exactly hyper-growth anymore.
But then look at the corporate profitability, the overall company gross margin. It expanded significantly over that same period. It went from 43.3% in FY22 up to 46.2% in FY24.
Almost 3 full percentage points of margin expansion while revenue was flat.
Exactly. That margin expansion achieved without top-line growth is the smoking gun. It's the unequivocal proof that the structural shift is working. They are successfully offsetting the mature, lower margins of hardware with the much higher margins from the growing services segment.
That's fascinating, and it really highlights the slowdown in the core iPhone business, too.
It really does. I mean, the iPhone segment is still huge, about 51% of revenue.
Yeah.
But look at the numbers. $205.5 billion in FY22 and basically flat at $201.2 billion in FY24. 3 years of no growth.
Confirms that the hyper-growth phase for the iPhone itself is well and truly over.
Absolutely. So the fact that the overall corporate gross margin is still rising despite that stagnation in their biggest segment, that confirms they are successfully transitioning. They're leveraging those 75% plus services margins to lift the entire company average. That's the platform company story justifying the premium valuation.
The usual story about Apple innovation is always about what's the next big hit product, like the next iPhone or something totally new.
Right. The next revolutionary device.
But the analysis suggests their R&D strategy now is maybe different. More defensive. It seems less about launching brand new standalone businesses and more about, well, deepening that ecosystem moat we talked about earlier.
I think that's exactly the right way to look at their, $31 billion R&D spend. It's largely focused on vertical integration and creating these technological differentiators that competitors just can't easily copy, things that make the ecosystem stickier.
And the prime example of that has to be Apple Silicon, right? The M-series chips in Macs and iPads.
Absolutely. That move to designing their own chips in-house, starting with the M1, that's arguably the most significant internal shift Apple has made since, well, maybe since the original iPhone.
Why is it such a big deal, better performance?
It's much more than just raw speed. It enables a level of vertical integration that companies relying on off-the-shelf chips from Intel or AMD simply cannot match.
How so?
Apple designs the CPU, the GPU for graphics, the neural engine for AI tasks, even the memory, all onto a single, highly optimized chip package, the system on a chip, or SoC.
Okay, so tight integration. What does that mean for me, the user?
It translates into massive advantages in performance per watt of energy used, which means dramatically better battery life for laptops.
Oh, okay, that's huge.
And because Apple controls the entire stack from the silicon architecture all the way up to the macOS operating system, they can optimize everything to work together perfectly. This lets them roll out features and performance levels that competitors struggle to replicate.
So it deepens the moat by creating a better user experience that's hard to copy. Makes sense. What about privacy? That seems like another key differentiator they push hard.
Privacy has become a fundamental competitive weapon for Apple. They strategically position themselves as the privacy-conscious alternative to data-hungry rivals like Google and Meta.
Right, they market that aspect heavily. What are the actual features?
Well, things like App Tracking Transparency, or ATT, that's the feature that forces apps to explicitly ask your permission before they can track your activity across other apps and websites.
Yeah, that caused a big stir, especially for companies relying on ad tracking.
It directly impacted their business models, yes. Apple also emphasizes doing as much processing as possible on the device itself for sensitive tasks. Think about their new Apple Intelligence. AI features, many of them run locally, minimizing the amount of your personal data sent to the cloud.
Okay, on-device processing for privacy.
Right. And even when they do analyze data in aggregate, they use sophisticated techniques like differential privacy. This basically adds statistical noise to the data, allowing Apple to see broad usage trends without ever being able to identify or compromise any individual user's information.
That sounds complex, but it fits their premium, trustworthy brand image, I suppose.
It does. It's a strategic pillar.
Okay, shifting gears a bit. Let's talk about the Vision Pro. The spatial computer, high price tag, launched last year. Where did this fit into the innovation picture right now? Is it the next big thing or?
Vision Pro launched in 2024 at, yes, a very steep $3,499. It's best viewed as a classic Apple long-term strategic bet, not a current growth driver.
Okay, so not selling in huge numbers yet.
No, initial consumer sales were pretty sluggish. Estimates are generally under 1 million units sold. The high cost is one factor, but also the app ecosystem is still very nascent, very limited right now.
So why do it? What's the strategic value?
Well, several things. It establishes Apple's vision for a new user interface paradigm, what they call spatial computing. It also showcases their dominance in cutting-edge technologies like high-resolution, micro-OLED displays, and, again, custom silicon designed specifically for this demanding task.
So it's like planting a flag for the future, demonstrating capability rather than a current commercial success.
Exactly. It's a strategic beachhead. But it is finding some traction in niche areas.
Oh, yeah. Why?
Mostly in specialized enterprise applications where that high cost can be justified. We're seeing uses in things like pilot training, using realistic flight simulators, or in automotive design where engineers can collaborate remotely on complex 3D models of cars.
Interesting. So specific high-value use cases.
Right. but its long-term mainstream success, that absolutely depends on building out a compelling third-party app ecosystem. They need developers to create those killer apps that make the complexity and cost worthwhile for regular consumers. That's the path from niche tool to new computing platform.
Okay, that makes sense. Now let's talk about the big one, artificial intelligence, AI. Apple's generally seen as, well, maybe playing catch-up here compared to the buzz around Microsoft OpenAI and Google.
That's definitely the perception in the market, yeah, that they were a bit behind, especially on the generative AI front.
But their big strategic pivot earlier this year, that tells a different story, doesn't it?
It tells us they're absolutely serious about catching up and doing it in their own distinct Apple way. The most powerful signal of this seriousness was the decision back in February 2024 to cancel Project Titan.
Right, the decade-long effort to build an Apple car. That was huge news.
It was massive, and sources indicated that decision wasn't just about abandoning a difficult project. It was explicitly made to reallocate huge resources, billions of dollars, and, reportedly, several thousand engineers directly onto their AI initiatives, what they now call Apple Intelligence.
Wow, so they chose AI over the potentially trillion-dollar automotive market.
That's a massive statement about their internal priorities, isn't it? It says they believe integrating AI deeply into their existing platforms is more critical to their future than trying to enter the incredibly complex, capital-intensive car business.
So what is their AI strategy then? Apple Intelligence.
Their approach seems heavily focused on integrating generative AI features directly into the core operating systems and apps, improving Siri, summarizing emails and mail, drafting messages, that kind of thing.
Making the existing experience smarter.
Exactly. But the crucial difference, tying back to privacy, is their emphasis on performing as many of these tasks as possible using on-device processing thanks to those powerful M-series and A-series chips.
So powerful AI features, but without necessarily sending all your data to the cloud. Ties back to the privacy mode again.
Precisely. It allows them to offer advanced AI capabilities while reinforcing their core privacy guarantee. It's a very Apple way to approach AI.
Okay, and one last area of innovation. Health technology. The Apple Watch seems central here, moving beyond just fitness tracking.
Yeah, health is definitely shaping up to be a critical pillar, especially for growing that high-value services segment. The watch is already a pretty sophisticated health device, right, with ECG, blood oxygen sensors.
Sure, lots of sensors.
But the company seems to be pursuing much more ambitious goals now, things that go beyond just selling the hardware. There are reports about an AI-powered health coaching service, apparently known internally as Project Mulberry.
AI health coach, what would that do?
The idea, presumably, is to leverage all the continuous, personalized health data collected by the watch activity, heart rate, sleep patterns, and combine it with proprietary AI models to provide users with tailored advice on lifestyle, fitness, maybe even diet.
So moving health from just being a feature of the watch to becoming a subscription service powered by the watch.
Exactly. That turns health into a source of high-value recurring subscription revenue. It directly drives up that ARPU number we talked about. It's a key part of monetizing the platform further.
Okay, so we've talked about the strengths, the ecosystem, the shift to services, the innovation. But this brings us squarely to the really big threats facing Apple now.
Yeah, the headwinds are significant.
It seems like the very thing that makes them strong, that integrated ecosystem, the walled garden, is now the thing attracting the most intense scrutiny from regulators and governments worldwide. It's almost like their greatest asset has become their biggest liability.
That's the central paradox for Apple today, absolutely. The regulatory assault is coming from multiple directions, it's comprehensive, and it strikes right at the heart of that highly profitable services business model.
Let's start with Europe, the Digital Markets Act, the DMA. That seems like a direct hit.
It is. The DMA is landmark legislation. It specifically designates Apple as a powerful gatekeeper platform. And because of that designation, the law forces them to make some fundamental changes.
Like what, specifically?
Most importantly, they have to allow alternative app marketplaces on the iPhone, what people often call sideloading. And they also have to allow developers to use third-party payment systems within their apps, bypassing Apple's own payment system.
And bypassing Apple's 15 to 30% commission, presumably. That sounds like it could directly slash those 75% plus services margins we discussed.
It's a direct threat to that commission structure, yes. Now, Apple is complying with the letter of the law in the EU, but they've also implemented a counter-strategy to try and protect their economics.
Oh, what's that?
They introduced something called the Core Technology Fee, or CTF, specifically in the EU.
Core technology fee.
Yeah. So while developers can use alternative app stores or payment systems, if their app becomes really popular, defined as over 1 million installs annually, they then have to start paying Apple a flat fee of zero point 0.5 euro for every single install after that first million, even if the user got the app from a third-party store, and even if the developer isn't using Apple's payment system.
Wow, okay. So even if they leave the main app store, if they get big enough on the iPhone platform, Apple still gets paid per user.
That's the idea. It's Apple's attempt to structurally maintain some economic control over their platform, arguing they provide the core technology and access to the user base, regardless of the distribution method. It ensures that highly successful developers still contribute financially to the platform they benefit from.
That sounds controversial. I bet developers aren't thrilled.
It's extremely controversial, and it's already facing legal challenges and regulatory scrutiny itself, but it shows just how hard Apple is fighting to defend the profitability of that ecosystem moat, even when forced to open the gates a little. We've already seen them get hit with a 500 million fine in the EU for breaching related anti-steering rules, too.
Okay, so the EU is a major battleground. What about here in the US? There's a big antitrust lawsuit too, right?
Yes, the U.S. Department of Justice filed a major lawsuit in March 2024, and this one feels potentially even more comprehensive, more fundamental.
How so? What's the DOJ alleging?
They're challenging the very integration of the ecosystem itself, arguing that the way Apple ties everything together is anti-competitive.
So not just the App Store rules, but how the products themselves work together.
Exactly. The lawsuit specifically calls out things like the iMessage lock-in effect, the green bubble phenomenon we mentioned, arguing it discourages switching. It also targets Apple's refusal to open up the iPhone's near-field communication NFC chip to third-party digital wallets like Google Pay.
Right, you can only use Apple Pay for Tap to Pay on iPhone.
Correct. And they also cite restrictions Apple places on cloud gaming services, making it harder for platforms like Xbox Cloud Gaming or NVIDIA GeForce Now to offer seamless experiences on iOS.
So if the DOJ were to win this, what could happen? What would be the remedy?
A negative outcome, a loss for Apple, could potentially force them to unbundle some of these core, deeply integrated features.
Unbundle.
Meaning, they might be legally required to make things work better with competitors. Imagine if they were forced to open up that NFC chip. So you could choose Google Pay or another wallet for tapping your iPhone. Or if they had to make iMessage fully interoperable, feature for feature, with Android messaging apps like RCS.
That would definitely reduce the friction of switching away from iPhone. It would weaken those psychological switching costs.
Significantly. It would force Apple to compete more directly on the merits of each individual feature, rather than relying so heavily on the cohesive, somewhat closed-off strength of the entire integrated platform. It could really erode the moat over time.
Okay, that's a major threat. And then there's also this growing movement around right to repair. How does that fit in?
Right to repair legislation, which we're seeing pass in states like New York and California, is maybe a quieter threat, but it's still significant.
What does it require Apple to do?
It generally forces manufacturers, including Apple, to make genuine replacement parts, diagnostic tools, and repair manuals available to independent repair shops and even directly to consumers.
So you wouldn't have to go to the Apple Store or an authorized repairer for everything.
Exactly. And this hits Apple in two ways. First, it directly threatens the profitability of their own repair services, which are known to be very high margin. If independent shops can do it cheaper with genuine parts, Apple loses that lucrative repair revenue.
Okay, makes sense. What's the second impact?
Critically, it could also contribute to further lengthening those device replacement cycles we talked about earlier.
How so?
Well, if you can easily and affordably get your slightly older iPhone screen replaced or a fresh battery put in by a local independent shop, you're probably less likely to feel the need to rush out and buy the brand new model this year. Cheaper repairs could mean longer device lifespans.
Right, another headwind for new hardware sales.
Yeah.
Okay, shifting from legal and regulatory to geopolitical risks. China seems like a huge challenge right now.
China is a major headache for Apple at the moment. Their revenue from Greater China actually declined by 7.7% in fiscal 2024.
Why the decline? Just a slowing economy.
It's more complex than just that. It's really a multi-pronged issue. First, you've got incredibly fierce competition from a resurgent Huawei.
Right, Huawei came back with new 5G phones despite U.S. sanctions.
Exactly. Phones like their Mate 60 series, using domestically produced chips, have really resonated with Chinese consumers, partly fueled by nationalism. They've clawed back significant market share directly from Apple.
And isn't there political pressure too?
Yes, that's the second major factor. There have been widespread reports of Chinese government agencies and state-owned enterprises restricting their employees from using iPhones for work purposes.
Now that's direct government interference.
It is, and it just demonstrates that even the power of Apple's brand and ecosystem can be challenged or even overridden by strong nationalist sentiment and direct political directives within a key market like China.
That volatility in China must be a big driver behind their push to diversify the supply chain, right? The whole China plus one strategy.
Absolutely. The heavy reliance on China historically, maybe 90% or more of iPhone assembly happened there, became a massive geopolitical risk, especially with U.S.-China trade tensions simmering.
So China plus one means moving production elsewhere.
It's a strategy to significantly reduce that concentration risk. It involves a complex, very expensive, multi-year effort to build up manufacturing capacity in other countries.
Where are they focusing?
India is the biggest target right now. Apple has an aggressive goal. They want to be producing 25%, a full quarter of all iPhones in India by 2027. That's up from maybe around 15% in late 2024.
That's a rapid scale-up. Are they moving other products too?
Yes, they're also expanding production significantly in Vietnam, particularly for products like MacBooks and AirPods.
Sounds like a massive undertaking. Is it going smoothly?
It's incredibly challenging. You can't just replicate China's super dense, highly efficient, and mature electronic supplier ecosystem overnight in a new country. There are hurdles with infrastructure, skilled labor, logistics, local regulations.
And probably political friction too.
Definitely. Reports suggest Beijing isn't exactly thrilled about this shift and may be trying to slow down the transfer of advanced manufacturing technology, key talent, and supply chain expertise out of China. It's a complex, high-stakes balancing act for Apple.
Okay, so we have this picture of incredible ecosystem strength, a profitable shift to services, ongoing innovation, but also these really serious regulatory and geopolitical headwinds. What does this all boil down to for investors? A huge part of the Apple story, maybe the biggest part for shareholders recently, seems to be how they handle their cash. They generate so much of it.
The cash flow generation is just phenomenal, truly staggering. In fiscal year 2024, Apple generated $118.3 billion in cash just from its operations.
$118 billion.
Yeah.
In 1 year. What do they do with all that cash?
Well, management has a very clear, stated long-term objective for their capital structure. They aim to achieve what they call a net cash neutral balance sheet.
Net cash neutral, meaning zero cash.
No, not quite zero cash. It means they want their total cash and marketable securities to roughly equal their total long-term debt.
Why aim for that balance?
The idea is it gives them financial flexibility. They still have a large cash cushion, but it ensures that excess capital isn't just sitting idly on the balance sheet, earning very little. It forces them to return that excess capital to shareholders.
Okay. And how do they return it? What's the main mechanism?
Overwhelmingly, the primary tool is share buybacks, massive systematic share repurchases.
Right. They announce these enormous buyback authorizations.
They do. The most recent one, announced in May 2024, was for an additional $110 billion. That's the largest single buyback authorization ever announced by any company, period.
$110 billion just for buying back their own stock.
Yeah.
Why is that such a core part of the strategy?
Because it's an incredibly powerful way to directly boost shareholder returns, specifically earnings per share, or EPS.
How does that work exactly?
Well, EPS is calculated by taking the company's total net income and dividing it by the total number of shares outstanding. When Apple buys back its own shares, it reduces that denominator, the number of shares outstanding.
Fewer shares to divide the profit among.
Exactly. So even if the total net income, the profit, stays exactly the same, the earnings per share goes up simply because the share count went down. It provides this consistent, non-operational, purely mathematical boost to EPS growth.
So even if the iPhone business is flat, as we discussed, the EPS number that investors see can still be rising significantly just because they're shrinking the share count.
Precisely. It's a form of financial engineering, essentially. And it creates this persistent tailwind for per-share growth, independent of whether the underlying business operations are actually growing profits that year.
That seems important for investors to understand, to separate the real growth from the buyback effect.
It's absolutely critical. You need to distinguish between EPS growth, driven by genuine business improvement, higher net income from selling more stuff or improving margins, and EPS growth, driven purely by reducing the share count. Both benefit the shareholder in the short term, sure, but only the operational growth really speaks to the long-term health and competitiveness of the business itself.
And they actually issue debt sometimes to help fund these buybacks, right? Even with all that cash flow.
Yes, they strategically use the corporate bond market to issue long-term debt at relatively low interest rates. This helps fund the buybacks without draining their operational cash too quickly, effectively leveraging their massive cash flow generation to maintain the momentum of the repurchase program. It's all part of that net cash neutral balancing act.
Okay, so buybacks are the main event, but they do pay a dividend too, don't they?
They do. Apple maintains a very consistent, steadily growing dividend. They've increased the payout for, I believe, 14 consecutive years now.
But it's not a huge dividend yield, is it?
No, the yield is relatively low. And importantly, the payout ratio, the percentage of their earnings paid out as dividends, is kept very conservative. It's only around 15.5%.
So they're only paying out about 15 cents of every dollar they earn as dividends.
Roughly, yes. And that conservatism is strategic. It signals that the dividend is incredibly safe, easily covered by profits many times over. But it also means that the vast majority of that enormous cash flow, the other 84.5% of earnings, plus the existing cash pile, remains available to fuel that absolutely massive share buyback program. The buybacks are the priority.
Okay, got it. Let's circle back then to the valuation. You said Apple's like two companies.
hmm
If that's true, we can't just slap a single PE multiple on the whole thing, can we? We need that sum of the parts approach.
Exactly. Thinking about Apple as two distinct entities is really the only way to logically arrive at and justify that current premium valuation around 33 or 34 times trailing earnings.
So how does that SOTP analysis work? Break it down.
Okay, first you take the traditional hardware business. That's still about 75% of the revenue, but as we discussed, it has lower gross margins, around 35%, and it operates in mature, often cyclical markets, smartphones, PCs.
Right, the slow lane.
So logically, that part of Apple should be valued like other mature consumer electronics companies. Think about companies like HP or Dell, maybe. What kind of valuation multiple do they typically get?
Usually pretty low, right? Low double digits maybe.
Exactly. Often in the low to mid-teens price to earnings ratio range, maybe 12 times, maybe 16 times earnings on a good day. A low multiple reflecting the maturity and cyclicality.
Okay, so value the hardware like HP.
Yeah.
Then what about the services side?
Then you look at the services business. Now, that's about 25% of the revenue, but it's growing much faster, double-digit growth. And crucially, it has those incredibly high gross margins, over 75%.
The fast lane, high margin business.
Right. So that segment needs to be valued differently. It should be valued more like a premium software as a service or a SaaS platform company. Think about high-quality software peers with strong recurring revenue and high customer retention companies like Adobe, maybe Salesforce in its growth phases.
And those kinds of software companies typically get much higher valuation multiples, don't they?
Historically, yes, much higher. Depending on their specific growth rate and margin profile, they often justify PE multiples of 30 times, 40 times, sometimes even higher, a premium multiple for predictable high margin growth.
So you apply a low multiple to the hardware part, a high multiple to the services part.
And then you essentially blend those two valuations together, weighted by their respective contributions to revenue and, perhaps more importantly, to profit or gross margin. When you do that math, the combined blended average multiple mathematically works out to be somewhere in that low to mid-30s range, which is where Apple's current PE ratio sits.
So the current 33.8x multiple isn't necessarily crazy. It just reflects the market heavily weighting the high-value services part of the business.
Precisely. It confirms that the market is essentially betting that the sustainable, high-growth, high-margin future of the services business will continue to expand its share of the overall profit pool, lifting the entire corporate average valuation and offsetting the lower valuation warranted by the maturing hardware side.
But this brings up a really important point, doesn't it? You mentioned the financial engineering from the buybacks.
Yes. That entire net cash neutral policy driving the aggressive buyback program, it creates this constant, almost guaranteed mathematical tailwind for EPS growth. Growth that happens regardless of whether the actual business is innovating or gaining market share.
So as an investor looking at this,
You, as the investor, have to be really critical here. You need to constantly try and disentangle that EPS growth. How much is coming from genuine operational improvements, selling more services, expanding margins further, and how much is just coming from shrinking the share count through buyback?
because the buyback fuel might run out or become less effective if the stock price gets too high.
Or, more fundamentally, if those regulatory headwinds we talked about actually start to bite and compress those critical 75% plus services margins, the operational engine might slow down. Understanding that distinction between financial engineering and real operational health is absolutely key to assessing the true long-term risk and reward profile here. Hashtag conclusion and key takeaways.
Okay, we have covered a tremendous amount of ground here. The blend of Apple's ecosystem strength, that crucial financial shift towards services, their innovation pivots in areas like silicon and AI, but also these really significant regulatory and geopolitical risks.
It's a complex picture, definitely.
So, to help you, the listener, monitor this ongoing story and decide for yourself whether that, let's call it 34x valuation, is justified going forward, what are the absolute key things to watch? We've distilled it down to 5 main key performance indicators, or KPIs. First, and maybe most obviously, the services revenue growth rate. This is the headline number for the bullish thesis. It really needs to sustain strong double-digit growth, ideally 12% or higher year after year, to keep justifying that premium valuation.
Right. If that number starts to significantly decelerate, it suggests either the monetization strategy is hitting a wall, or maybe that regulatory pressure is finally starting to impact the top line. Big red flag if that slows too much.
Second KPI, gross margin trends, specifically broken out by segment. You can't just look at the overall corporate margin. You need to drill down and watch that services gross margin number very closely. Is it holding above 75%?
Exactly. You're looking for any signs of compression there. Is the EU's DMA, or maybe that core technology fee structure, not working as planned, starting to erode that incredibly valuable margin? That services margin is arguably Apple's single most important financial asset right now.
Third, active installed base growth. We talked about the 2.3 billion number. That total pool of active Apple devices globally is the absolute foundation for all future services revenue.
Doesn't matter how much ARPU potential there is if the user base stops growing.
Precisely. Even if people are buying new iPhones less often, that total number of active devices needs to keep ticking upwards, even modestly. If the installed base stalls or shrinks, the entire services growth story becomes much, much harder and much riskier.
Good point. Growth in the base is fundamental.
Fourth KPI.
Yeah.
Keep an eye on the geographic revenue mix. 2 things here. First, watch for stability, or hopefully a rebound, in that volatile but huge Greater China market after the recent declines. Second, look for accelerating growth in those strategically important emerging markets, particularly India and maybe Indonesia, where Apple is investing heavily in both sales and production diversification.
Yeah, geographic performance tells you a lot about competitive pressures and diversification success.
And fifth, finally, keep tracking the iPhone replacement cycle data. This comes from industry analysts usually, not directly from Apple. But if you see reliable data showing that cycle lengthening further moving beyond the current 3+ years towards maybe 4 years, that's direct persistent headwind.
Right. It hits the biggest, albeit slower growing revenue segment directly. And it forces Apple to rely even more heavily on extracting value from services and engineering growth through those buybacks.
Okay, those are the 5 key things for you to monitor. Services growth rate, segment margins, installed base, geographic mix, and the replacement cycle.
That covers the core dynamics pretty well.
So to wrap things up, maybe leave our listeners with one final thought to chew on.
Okay, here's something to consider. Apple's financial efficiency, as we noted, it's just off the charts. That $118 billion in cash from operations last year, it absolutely dwarfs their capital expenditures. CapEx was only about 8% of their operating cash flow.
Tiny reinvestment rate, relatively speaking.
Incredibly low. And what that efficiency means is that the vast, vast majority of the cash Apple generates is effectively already legally or strategically committed to that massive shareholder return program, primarily the buybacks. Now, juxtapose that with the immense regulatory pressure, we discussed pressure from the EU, the US DOJ, others specifically aimed at dismantling or weakening the high-margin App Store business model that fuels so much of that profit.
Right, the core of the services engine is under attack.
So here's the fundamental question you need to consider. Can Apple innovate fast enough? Can they really create the next $100 billion annual revenue stream, whether it's from AI integration, health services, maybe the Vision Pro platform eventually taking off, or something entirely new? Or is their long-term investment case now primarily reliant on just buying back their shares faster than those core services margins potentially decline under regulatory pressure?
Innovation versus financial engineering, basically.
That's the core tension. Which force will win out over the next decade? That trade-off will likely define Apple's future trajectory.